Welcome to Watches with Dennis, and today I want to talk about why I am predicting that some gray market watch dealers are going out of business in 2022. I thought about not including the word some and then just having a more clickbait title, but I wanted to be fair about it, and I don't think I'm being particularly bold in these predictions, and I'm sure a lot of this has been discussed online in various forms about why this might be happening. I think it really distills down into 3 points. Actually, we could distill it down all the way into 1 point, but I want to go ahead and give some background into the third item that I'm going to list because I think the two contributing factors help explain it a lot better to get a good overall sense about what's going on in the market broadly and why that's affecting watches and why I think that's going to affect how many gray market watch dealers we see at the start of 2023 versus what we see right now in the industry. The first item I want to talk about that I think is related to all of this is pandemic versus post-pandemic. And by that, I'm talking about the funding and the behavior of people that we saw during the pandemic and what we're seeing now. Now, the pandemic in and of itself is not gone. Coronavirus has not gone away. But what I think is relevant is how people are behaving at this point. And I'm in the United States, and the behavior of the governmental response is much more in an endemic status now that vaccines are widely deployed and we have more treatments available, and the behavior of people are responding accordingly. But I want to start with the funding part first. So there's not a lot to this, and it varies nation to nation, but a lot of countries, when coronavirus arrived, because of the impact of stay-at-home orders, lockdowns, and other things that controlled and curtailed the movement of people, there was often seen by the governments as a need to provide support to individuals that may be negatively impacted by the control measures that were being employed. So here in the United States, we actually had several rounds, depending on your qualifications, of direct payment eligibility. And while the federal direct payments are the most famous ones, there were dollar allocations to lower levels of government that also implemented certain direct payments if they thought that they were necessary. The reason why this is related to the watch market, though, is even though these payments were to go to people in need, the thresholds were often defined around, like in these federal instances, income. So, for example, if you made under $75,000 as an individual, you could qualify for an over $1,000 payment. And not everyone who was in that income bracket actually needed these payments. A lot of them were still working. They were able to work remotely. The coronavirus had impacts on them, but they didn't have economic impacts on their ability to make money. So what happens when you give a direct payment to someone who hasn't seen a decline in their income? You've given them more disposable income to spend on something, anything that they might want, because they don't need to spend it on necessities. So during the pandemic, I think that there were a lot of individuals who did qualify for direct payments, be they federal, state, local, or whatever other government they might live under. And some of those people used that to invest in their hobbies. And so in the case of watch collecting, that allowed them funding to buy watches they would not otherwise have. Those funding payments are gone now. I'm not aware of, at least in the United States, I'm not aware of any continued direct payments other than some of these programs that might have had further out deadlines. People may still be applying for certain funding, particularly the non-federal supplied funding. But setting those aside, that part of the pandemic response is over now. So this additional discretionary money to spend on watches is down now versus what it was during the pandemic because these direct payments are no longer moving forward. Now, the other side of the pandemic portion is the behavior side. And that, to me, really comes down to travel. One of the big things with lockdowns, and even when the lockdowns lifted over the coronavirus, there were a lot of people, be they immunocompromised, not yet vaccinated, whatever their situation was, they were uncomfortable traveling. Now people have become more and more comfortable traveling as our ability to address the disease has improved and the disease rates have declined versus the surges we saw under Delta and Omicron. So given that, we've definitely seen a high uptick in travel behavior. In fact, I know airlines had been reporting just a week ago about how they were setting near new records or new records, depending which airline it was, in terms of the amount of travel bookings that they were seeing. And so again, how does that relate to watches? inherently you wouldn't think, well, travel and watches, they don't necessarily go together, other than which watch do you pick to travel with. But if people are spending money on travel, that is less money they can spend on their hobbies. And I think that during the pandemic, when people were staying at home, they ended up investing in things aside from travel, whereas normally they would have traveled more. So if you normally take 2 trips a year and you're not taking any of those trips anymore, people pour that money into something else. What's something else fun that they can do if they're not going to travel? Some people put that money into doing home improvements. Some people put that money into their hobbies. So again, even they didn't qualify for direct payments in the pandemic, they may have had more discretionary income, especially if their own employment status was not impacted by the pandemic. And they poured that money into watches as a hobby versus flying to Cancun. That's not the case anymore. People want to travel. They've been cooped up for a couple of years. So in fact, I wouldn't be surprised to see more travel, and those airline numbers are to me suggesting it. People want to travel more now than they perhaps in a normal year would have, because it's just been so long since they were able to. So we might actually see less money available to a lot of individuals that would normally buy watches in the next couple of years as they get quote unquote caught up on all those travel desires that they did not engage in 2020 and 2021. Now, my second area that I think impacts what's going to happen with the gray market dealers is increased inflation and decreased stock market performance. Now, this is not a one-to-one thing, and this gets really complicated. I am not an economist. While I have done some economics course study as part of my educational background, that was not my focus area, so I'm going way above pay grade here, but I will do the best that I can to explain things as I understand them. So let's start with the inflation rate. In the United States, which again is the country that I am familiar with, we have been seeing an increase in inflation. And currently, and the current numbers I was able to pull were for March, not the end of April, because we're still technically in April, is approximately 8.54% inflation rate. Now, that is significant inflation compared to where we have been. The prior month, the February 2022 month, was 7.87%, and last year's inflation rate was just 2.62%. And the long-term average in the U.S. is about 3.24%. So you can see our inflation rate is significantly higher than where we typically average. Inflation in and of itself can have an impact on your ability to purchase a watch, because what inflation is saying is we are spending more to get something versus what we used to have to spend to get the same something. The problem is inflation doesn't affect everything equally. So, for example, if your necessities have gone up, let's say 8%, and your income has gone up, let's say 2%, then your discretionary income has fallen because you're spending more now on necessities than you increased in terms of gross income. So that obviously means you have less money to play around with. And that's not even factoring in that inflation also can impact watch prices. And I know a number of manufacturers. I still remember Stova announcing that at the end of December that as of January 1, they were raising all of their watch prices. And they probably have to do that from time to time, and maybe they do it annually no matter what. But if the supplies, the raw materials to make the watches have gone up because of inflation, that cost is generally passed on to the consumer. Now, the other aspect of the second point that I listed was the decrease in our stock market performance. And basically what I mean is stocks are down. Now, inflation and the stock market do relate, but they don't relate as cleanly as you might like it to. Some degree of inflation is actually good for the stock market. What I believe is more impactful to the stock market, driven by interest rates, is actually what governmental banks do in response to it. And in the case of the United States, we often talk about the Fed. And the main number we talk about with that is what we call the Fed funds rate. Now, I don't want to give a whole big dissertation on what all this means, but essentially, the Fed funds rate is an interest rate that banks and other institutions lend money to one another at. It's usually for an overnight loan. Banks in the U.S. have to keep a certain percentage of consumer funding in reserve, and they don't earn interest on that money. So banks try to stay as close as they can to that reserve level without falling below the legal limit, and they lend money back and forth in order to maintain that level. So the government notices that inflation is going up higher than they want. They will use the Fed funds rate to control the supply of available funds. By raising the rate, the Fed makes it more expensive to borrow money. That lowers the supply of available money, And that increases short-term interest rates, which helps keep inflation in check. And obviously, if they do the opposite things happen. So currently, the Fed funds rate is 0.5%. And that was the same last month. But a year ago, it was only 0.25%. So in an attempt to control inflation, the Fed has started to pump the brakes by increasing the Fed funds rate. Now, obviously, the increased rates on borrowing money have trickle effects that impact consumers because it can cost them more to borrow money themselves, which gives them less discretionary income because they're paying more in interest. So that would have an impact on your ability to buy watches. But this also impacts the stock market because generally speaking, if the Fed funds rate goes up, that increases the opportunity to make money off of interest from issued treasury notes, annuities, those sort of things. So investors might think that moving to those more secure markets, the bond markets, are better than staying in a more equity market or the stock market. And again, the opposite happens if you were to cut the Fed rate, which is why keeping the Fed rate low is popular with stock investors because it increases the growth in the engine of the stock market. The idea is you want to put money in stocks because you're not going to get any money any other way. And I think anyone who's tried to earn money off of, say, a savings account over the last few years has recognized the complete futility of those abysmal interest rates. When I was a teenager, savings account interest rates were not terrible. They weren't great, but they weren't terrible. Now, I mean, you don't even get 1%, or at least I don't. So raising these rates, these Fed funds rates, means that those secure, safe investments are going to go up, and some people are going to turn to that versus the stock market, which could drive down the stock market. And it's noteworthy to say that while changing the Fed funds rate can take about a year to have broad, widespread economic impact, the stock market usually responds to the change pretty quick. So let's talk about the stock market because that is the second half of my second point here. And those are down. I think anyone who's got shares in broad-based like mutual funds have probably noticed that it's down. The S&P 500, which is one of several indexes that can be examined, has fallen. One can see in this image that as of April 25th, its month-long change is a decline of about 6%, a little over 6% fall. And obviously, that in turn impacts available funding. If people have been funding their hobby, their watch purchasing, not via the income they make at their job, but rather via the performance of their investments, if their investments are not performing as well, then obviously they have less disposable income to spend on their hobbies. So both of these, the pandemic versus post-pandemic and the inflation and stock market changes that we're seeing, all feed into my third item, which is falling secondhand watch prices. And we have metrics for that as well. Now, looking at this chart from watchcharts.com, you can see that over the last 3 months, overall, there has been growth in watch market prices. Its lowest value is at the end of January. It peaks out at around March 31st, which was a value of $24,886. And I should note this chart is a market index. It's an indicator of the financial trends of the secondhand watch market, and it consists of 30 popular watch models that have high trade activity, according to watchcharts.com. So this is the average market price of those 30 watches over time. So that's where the 24,886 comes from. But it's fallen since then. Not by a lot. Obviously, it hasn't lost all the gains it's had since the start of the year, but the last month has seen a decline of 4.7%, which is not insignificant. So what does this all mean? Obviously, as I noted, I could have just started with point number 3, had it as my only point, and said, hey, we've got falling secondhand watch prices. The gray market is going to suffer for it. But I think the other items are important for explaining why they are falling. They're not just falling because they're falling. They're falling for a reason. And I've given my reasons related to the pandemic and related to inflation and related to stock market performance. Just because prices are going down doesn't mean all of a sudden all sorts of businesses go out of business. But why does that mean I think some gray market dealers are not going to be able to survive this? Well, all of it's speculation, of course. In part, I think that this trend line is going to continue to go down. I am not predicting that the watch market is in a bubble and that bubble is going to burst. I think some watches may be in a bubble and those bubbles may burst. But I don't understand enough of the details of those particular watch models to go into it. I don't follow really high-end luxury pieces, for example. And if there was so much puffery going on from some gray market dealers or hoarding certain models that they might have really artificially been able to control something, especially if there were really few number of units out there. It's not that hard for someone to control the valuation of something if there's just not a lot of it. But saying all that aside, I just think this trend's going to continue to go down because I don't expect to see inflation controls to kick in an adequate way for, as was noted, it could be up to a year before we see broad-based economic impact in the U.S. just based off of the Fed's interest rate changes. And then the stock market, again, well, are we going into a bear market? Possibly. Are we going to go into a recession? Again, above my pay grade, a pretty extreme stance at this point, but a market correction would not be surprising. My point is, though, that I don't expect the stock market to just start going up and up and up again like we were seeing for the last few years, because of all these other various confounding factors impacting the economy. I just think that this trend downward, even if it's a gentle slope, is going to be long-term. Not every gray market dealer, though, was prepared for something like this. In fact, I think there are a lot of gray market watch dealers, particularly what we would brand as the flippers. And those are the people that have been primarily going out there, getting the really, really popular watches, and then immediately tacking a few $1,000s more on them and trying to sell those off. I'm not talking about like the Joma shops, which are going out there and getting a lot of the not so popular watches and selling those off, or, you know, your tried and true watches, which had been popular before the pandemic and going up again, perhaps not aggressively, but gently and over time, no longer produced Rolexes, those sort of things. We'll still see watches that will go up in value. This is not an all in or not in at all sort of thing. But the flippers that were relying on really rapid trades, you know, doing the grind and trying to get something and then quickly make a bunch of money off of it, if they've got product right now and that product's already gone down, they're probably in a lot of trouble. I don't think a lot of them were very good business people. And by that, I mean, I don't think they were very savvy. And that's because, quite bluntly, when everything's going up, it's real easy to feel like a genius and think that you're always going to make money and that you're actually good at it when you have no idea how to actually price anything and predict anything. It's easy when everything goes up. There's no thought to it. But now, for those dealers that don't have a lot of cash reserves, everything's in product, and especially those that predicted that hype products were going to continue to go up. If those hype products are consisting of these 30 watches that we saw with watch charts that have an average price decline, they're in a lot of trouble because they'll have to sell now to just recoup part of what they've already put in. And again, maybe they only take that 4 to 5% loss that we're seeing on the average, and that doesn't sound too bad. But if they think this is just a blip, they might hold on to those products. And if those products continue to decline throughout the year, they're going to lose more and more money versus what they paid to get them in the first place. And for some of them, I think it's inevitable that they will not be able to continue to sustain their business. They'll be afraid to let go of the products. They won't want to lose money on anything. They'll hold on to them, diamond hands those watches, and then those watches just become less and less valuable. And eventually it becomes insurmountable. They'd have no cash to actually work with new watches. They're stuck holding the old ones, hoping that the old price comes back. And you can only live like that for so long, especially if you don't have a lot of cash available. So that's why I think some of the gray market dealers, I view a number of them as cropping up really recently. When, even if it was pre-pandemic, it was a really hot time. Like everything was going up, and it's super easy to feel super smart when that's happening. And I think those days are over, at least for a while. And because of that, some of these people are just going to have to move to another line of work. But anyway, those are my predictions. I might be completely wrong. Comment below on what you think. Do I make any sense? Do you have different thoughts about what's going to happen with some of these gray market watch dealers, the flipper types in particular? Do you have any thoughts about what we might see in terms of watch trends moving forward? Do you think this downward slide is going to go on for the rest of the year? Am I incorrect? Do you think it's going to recover much faster than I'm predicting? Go ahead and comment below. And if you enjoyed the video, please do give it a like. And if you want to be notified when I release a new video, just click the subscribe button. And I hope everybody has a great day. Take care.